The earnings report was flawless, record revenue, profit margins growing, guidance raised. The ticker lit up green, and yet, 2 floors down, an entire division was being shut down quietly. No announcement. Just a hallway of cardboard boxes and forced smiles. On the surface, the company looked bulletproof. From Wall Street's view, it was thriving. But inside, the numbers masked something else. Cost cuts, spiraling debt, layoffs labeled as restructuring. Multiply that by hundreds of companies, and you get a market that appears unstoppable, but is balancing on silence. This is not a crash story. Not yet. This is about the illusion how the market can look strong even as the foundation begins to give way. By nearly every traditional measure, the stock market should be showing signs of weakness. Inflation has remained stubborn. Interest rates have risen at the fastest pace since the 1980s. Consumer debt is at historic highs. Layoffs have multiplied across entire sectors, from tech to retail, and yet the markets climb. The S&P touches new highs. The Nasdaq posts double-digit gains. Headlines highlight record corporate buybacks, and investor sentiment appears oddly cheerful. The contradiction is clear. The economic signals are troubling, but the market refuses to follow the script. For decades, analysts have been trained to watch the lagging indicators, GDP, housing starts, unemployment rates, and use them to forecast market impact. But what if the market no longer cares? Today's market is not built on broad participation or balanced fundamentals. It is top-heavy, momentum-driven, and concentrated in a narrow set of narratives, especially artificial intelligence, automation, and digital platforms. This new shape of the market responds not to economic health, but to liquidity, confidence, and flow mechanics. And that makes it look strong. Until someone asks the wrong question. Why is the market rising when the underlying economy is signaling fatigue? The answer, hidden in plain sight, is that today's market strength is built less on earnings and more on engineered support. That support is not infinite. It is not stable. And once you see how it works, the illusion becomes difficult to ignore. If the stock market looks strong, it is because the machinery beneath it is still moving, but not necessarily in the way most people think. Beneath the surface, just a few forces are powering most of what we call market growth, and they are not built on widespread investor conviction. They are built on momentum, automation, and centralization. First, passive investing. Index funds, ETFs, and retirement plans now account for over half of the ownership in major indices. Unlike active managers, these funds do not evaluate fundamentals. They follow flows and mirror the index, when money enters the market. These funds buy in proportion to company size, meaning the largest companies get the largest share. By default, this creates self-reinforcing growth. As prices rise, the index weight increases. So funds buy more, pushing prices higher. Second, the concentration of market returns. In recent years, 5 to 10 mega-cap tech companies have accounted for the majority of market gains. These companies appear strong, and in many ways they are, but their valuations are based on assumptions about future growth that stretch far beyond what previous cycles would allow. And third, artificial intelligence. The excitement around AI is not just reflective, it is structural. Billions of dollars are flowing into every sector that claims to touch AI, regardless of profitability or maturity. These forces make the market seem unbreakable, but like all engines running above capacity, they generate heat, they look efficient, even elegant, right up until one part fails, and the system reveals how fragile it really was. In most market cycles, risk is loud. You see it in the headlines: failing banks, collapsing housing markets, runaway inflation, but in this cycle, risk has gone quiet. That does not mean it has disappeared. It has simply been moved to places where fewer people are looking. Since the 2008 financial crisis, regulators have tightened rules on traditional banks. Capital buffers increased. Transparency improved. On the surface, things look safer, but many of the most dangerous. High-leverage financial exposures did not vanish. They were redirected into the world of shadow banking, hedge funds, private equity firms, non-bank financial intermediaries, entities not subject to the same reporting requirements or capital. Reserve mandates now hold a growing portion of America's financial risk. Lending to distressed companies buying risky debt, making leveraged bets in thinly traded markets, all through entities outside the regulated banking system. This shift creates a mirage. The banks appear strong. Defaults appear controlled, but the actual structural vulnerability is growing, just not where the public can easily measure it. Add to this the rise of algorithmic trading, short-dated option strategies, and leverage built into passive portfolios. And you have a market that is heavily exposed but thinly protected. And when market sentiment finally turns, these hidden risks do not unwind slowly. They surface all at once. The illusion is not only that the market is strong, but that the risks are under control. Illusions can only hold as long as no one tests them. The moment confidence wavers, the structure starts to shake, not because fundamentals have changed, but because belief has. In today's market, that belief is doing the heavy lifting. Artificially low volatility, mechanical buying from passive funds, and overconcentration in a few massive tech stocks have created the visual of strength. But all it takes is a single catalyst. An unexpected earning miss, a sudden failure in the credit markets, a geopolitical shock, and the illusion starts to come apart. Passive investors, who once bought on autopilot, begin withdrawing. Leverage begins to unwind. Liquidity vanishes in the parts of the system where it was assumed to be permanent in that moment. The average strength of the stock market means little because the crash does not begin broadly. It begins with the most overowned names falling first, and then contagion. And if the last 20 years taught us anything, it is that markets do not correct gracefully. They snap, and when the illusion breaks, hindsight will write the headlines. Everyone should have seen this coming. But the real headline will be simpler. The market looked strong right before it was not. The danger in modern markets is not just volatility. It is comfort in momentum, comfort in policy support, comfort in the assumption that someone will step in. But comfort is not the same thing as safety. Today's stock market appears strong because the pipes are still pumping capital, but few are asking where it is going or what happens when the flow reverses. Risk has not been removed. It has been relabeled, repackaged, and redirected. The institutions that once shaped markets are now reacting to them. The price no longer signals strength. It signals how effectively the illusion has been managed so far. History is never loud in real time. It whispers at the top hand when the illusion breaks. It will not be a surprise. It will be a reminder that strength is not always visible, and neither is weakness. If the market's strength is real, why has it needed so much help to stay standing?